This is the Cryptonomics Podcast, telling you why cryptocurrencies are the kryptonite to the traditional banking and credit systems. Learn how to store, manage, and spend your wealth in the cryptoverse. Listen about Bitcoin, Ethereum, and decentralized finance, and hear from our successful crypto investors and miners about their strategies. Whatever you're interested in learning about, Cryptonomics is your one-stop shop to everything crypto. Now, here is your host, Ty.
Hey CJ, welcome back to this week's episode 2. Today we got a lot of fun stuff in store to talk about. But before we get into DeFi, Ethereum, and all that jazz, I thought that we could start off by kind of addressing what's going on in the real world. Everything that's been happening with Robinhood, GameStop, AMC, and kind of get your take on it, and then hear about how crypto can help solve the issues that we're going through. So why don't we go ahead and just jump right into it?
Sure, absolutely. So, what's going on in the markets right now is just absolutely unprecedented. What we see is that the big boys, the hedge funds, the Wall Street bettors, those guys don't care about the small man. They never have. The markets have always been rigged. You hear the term sector rotation, and that gets said on TV, and people are like, oh, yes. That makes sense. Sector rotation. You got to go, things are seasonal, blah, 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 blah. They just justify the ends to their means, which these hedge funds are big momentum cycles. They'll pile into a sector and then they'll filter out and pile into a different sector and filter out. And honestly, the credit systems are so bad today that the banks and the credit system are already going to fail. The way the banks make their money is with their trading desks. So if the banks didn't have their trading desks, they'd already be bankrupt and out of business. It's their trading desks that keeps them alive. And it's these hedge funds which go through sector rotations that produce those profits. And what we're seeing in GameStop and AMC is the Main Street is now saying, you know what, if you're going to play that game, we're going to play that game. But what we're finding out is that the elites live under a different set of rules than the rest of us. And that's really where cryptocurrency steps in, because cryptocurrency is run by the algorithm. It's run by the code. So the code doesn't care what color you are, how old you are, what language you speak, how much money's in your wallet. It simply doesn't care. It treats everybody the same. It treats everybody equally, and there's no bias. So you can trust the code to not be biased and to equally apply its law to each participant. Whereas in the traditional system, that is not the case whatsoever. You can see with the Robinhood shutdown, a little bit of the steps that they can take to change the laws and adjust the real world law and code to benefit them and hurt the small guy, right? Correct me if I'm wrong, but I believe Robinhooders couldn't even sell their positions.
No, I guess let's touch on that a little bit. Let's touch on exactly like what happened. So there was a big short interest on GameStop, correct?
That's right.
There were some big hedge fund was trying to short over 100% of the floating stock that was in the market, and the Redditors, the Wallstreet bets, I believe their name is, didn't like that. So what happened?
Yeah. So what happened is these people got squeezed out of their position, or what they call a short squeeze, which is just a way of saying for liquidating them, basically forcing them to close their position because the bet went so wrong in the wrong direction for them that they had to make good on it. And that problem lies with the laws for hedge funds to short the market, because they're allowed to short the market at what they call 15+2. So they have leverage that retailers don't even have. So what's really amazing is that retailers with just small margins and no leverage, basically, were able to short squeeze hedge funds who are able to use higher leverages that retailers don't really have access to. So this would actually be considered like a targeted attack. This would be considered, typically hedge funds work together. They share some data, they share some research, not all of it, but they always have a network of funds that work together. Again, that's how this momentum is driven through these sector rotations. And what we're seeing here is an outside player coming into the game. To draw a parallel, I don't like to get into politics when we're talking finance unless we have to, but this is a perfect parallel. Donald Trump came in as an outsider. He was not a politician his entire life. He was not sucking off the system his entire life. He didn't give two shits what anybody else had to say. He said what he thought. And that resonated with America because we've been sick of it. And what did they do to him? They deleted him. They shut him up. They got rid of him. They tried to impeach him. They tried to use the law against him, and they did it at every possible chance they could get. You're seeing that same power structure that took out Donald Trump, who was not part of the system, now coming to the Wall Street bettors, the people who are on Reddit who banded together like a hedge fund and took their purchasing power to squeeze out a position that they thought was not that smart to take, which it wasn't because they used too much leverage. And they went for it and they went on the attack. And now what's happening? Oh, somebody outside the system, the retailers, not the hedge funders, is coming in and making this happen. Shut down the exchanges. Make it so they can't buy anymore. Make it so they can't sell. We can't lose this money. We're the house. We're always supposed to win. What is this?
What happened is these hedge funds got caught kind of up in their own game, and this legion of retail investors really squeezed them out of this position. So then they what? They called up Robinhood and TD Ameritrade and told them to halt trading so that they could get out of their position, or what happened?
Well, I don't know if that happened for sure. I believe it did because it just wouldn't make sense. If you go and you look at the connections that there are, here's another great example. Robinhooders trade free, right? So it's a free platform that people are able to use. Well, so is Facebook. Facebook is free too. Please come share your data with us. Come share us everything about your life with us. And then the people who are using the platform, they become the product that Facebook makes money off of. How? By taking your data and selling it to companies. So the same thing here is going on at Robinhood. The customers who use the platform are really not the customers. Just like Facebook, the people who use the Robinhood platform are the product. What's being sold are the data flows, and they're being sold to the hedge funds who are the real customers. So he wasn't lying when he came on CNBC and said, I'm trying to protect my firm and I'm trying to protect my customers. Absolutely. You're trying to protect your self-interest and you're trying to protect the hedge funds who are your customers who buy that data flow that you collect from the product, who is the people who use your platform. So, that's what these people do. They're data miners, and they come out and they take people's data and they sell it. And Robinhood is no different. Their marketing gimmick failed horribly. I've never seen a company short their own IPO, but Robinhood shorted their own IPO.
It's amazing, man. It's amazing. I'm all pumped up by this, it's a bunch of people like you and me that banded together on Reddit and took out these billionaires. Obviously, what happened in the last few days is an issue. There's a lot of trust issues going on, a lot of manipulation. So my question is how does crypto and decentralized finance help solve the issues that are at hand right now, that are at least being discussed right now?
Right. So you remember from our first podcast, we talked about how one of the sayings for Bitcoin is to be your own bank. And it gives you freedom from that system where you have to place trust in companies and humans, and you can place it in the algorithm where there's a trusted layer that's already designed within the system itself. Well, the same thing is true when it comes to decentralized finance. So right now, people are trusting Robinhood, people are trusting TD Ameritrade to be your broker, to allow you to buy and sell equities and to custody those for you as well. So maybe even a better saying going into cryptocurrency, somebody should make a t-shirt with this, be your own broker, because that's what's going on right now.
Maybe
DeFi.
We should make that t-shirt.
Decentralized finance allows you to be your own broker. So Bitcoin allows you to be your own bank, to store your own value, and decentralized finance allows you to be your own broker or to custody and manage your own wealth.
Just to clarify, decentralized finance is DeFi, right?
Yeah, DeFi is the shorter way to say it. Yep.
Yeah, it's like the slang.
Yeah, absolutely.
Okay. So explain DeFi like I'm 5 years old.
Okay, so when you go to the bank and you deposit $100 into your savings account, they're going to tell you you're going to earn X percentage of interest on this deposit. Now, what you don't see going on in the background is that the bank takes your $100, and pre-coronavirus, they used to follow this law called fractional reserve banking, where if they have $100 in deposits, that means they can loan out 10 times the rate. So they would write loans for $1,000. And then people would take that money and they would go and they would buy goods and services, build a house, do whatever they're loaning the money for. Well, as those people started to pay back that loan, they're paying back that loan with interest. Well, the bank would then take a portion of that interest and give it to you, since you were the original depositor. And without you being the original depositor, they wouldn't have been able to write that loan because they needed your $100 deposit to write the $1,000 loan. Therefore, when they collect interest, they take their cut and they give you a cut as well as an incentive to deposit into your savings account.
Is that like the interest you get for holding your money with the bank?
Yeah, absolutely. That's those interest rates right now in the bank are so low, and even CDs are extremely low when you have to lock your money up for a certain amount of time because the credit markets are broken. The credit markets are broken. So we have a problem and we have a solution. The problem is the credit markets are broken. The solution is DeFi. The problem is we don't trust our brokers. The solution is to be your own broker. So let's start with the first problem, with the credit system being broken. When banks have to write loans for small returns on investment, for a small percentage, for low interest rates, then they're not going to make that much money. So a lot of people, they think low interest rates are good. And that's simply not true. Low interest rates are not good. And here's why. Because even though the bank writes a loan, the interest is so low, especially commercial interest, because the federal funds rate is 0 to 0.25%. Now, consumer rates like you and me who want to buy a house and have to worry about our credit score and our cash flows and stuff like that, our consumer rates are anchored to the federal funds rate, but they're not the same. Obviously, you're going to be somewhere between 3 and 6% depending on your credit score if you want to buy a home today. And those keep going lower and lower and lower, and people keep getting happier and happier and happier. But that's the bad way to incentivize a market, because what's happening is the people who can take the risk takers, they're paying very low interest on their loans. And that means the people who can't afford to take the risk, who are the savers, the people who can only just keep their money in the bank account, they're not starting a business or buying a rental home. They can't afford to do that. They're in the process of saving up so that they can do something like that. Well, growing up, you might have heard the power of compounding interest, the power of compounding interest. That doesn't exist anymore in the traditional system because there's no interest to be compounded. People get paid less than 1% interest on their savings account. So how is that going to compound? It's not. A healthy credit market is going to be somewhere between 7 and 12%. And borrowers who can afford to take the risk are going to borrow between 7 and 12%. But what that allows the banks to do, or the brokers who are brokering those loans, they can then take the saver, that person who put that $100 in, and instead of just giving them pennies, they can actually now give them a higher percentage savings interest rate. So if they write a loan for 12%, they can pay the saver 8%, and the bank keeps 4% for themselves. The bank is incentivized to write healthy loans. The savers are incentivized to deposit because they can grow their wealth with the power of compounding interest with zero risk, by the way. That's a big factor. People talk about real estate. Well, there's a lot of risk in real estate. Real estate prices can very easily collapse 30%. And then over the next 4 years, maybe you could generate 36% ROI or 40% ROI, 9%, 10% per year. Fantastic. But you're risking 30% to do that. If there were a savings account in the traditional bank that paid 7 to 8% interest, then you wouldn't have to risk anything. You would have dollars in your savings account the value cannot go down, and you're generating 7 to 8%. So maybe you only generate 28 to 32% instead of 36 to 40, but you're taking way less risk. And that allows you to get to a position to one day where you can then turn your savings into a loan and then take a risk, buy that house that you're going to be able to generate, expand your wealth, diversify from that dollar, or even build up your savings large enough to where you don't have to work anymore.
So basically right now, if you want to try to like grow your money, the only really way to do it is to take a loan and invest in assets. If you just let it sit and try to collect interest within the bank, you're never really going to grow because the interest rates that you're getting paid on your money is just so low.
That's right. The banks and the Federal Reserve are forcing you to take risks to grow your money. That's the problem. The problem is that they're forcing you to take risk and they're not giving you any reward because the credit system is broken because the rates are being suppressed and people think it's a good thing.
So how does DeFi solve that?
So the solution is DeFi, because what happens in decentralized finance is the credit markets are much healthier. The rates are based on the supply of money and the demand on loans. It's a free credit market, unlike the traditional market where the rates are controlled by human beings. So there's politics, there's emotion, all of that plays a role in the traditional credit rates.
So instead of the credit rates being dictated by a centralized bank like the Federal Reserve, it's actually dictated by however much people are willing to pay, the free market.
Absolutely correct. Absolutely correct.
I mean, that makes a lot of sense.
Yeah.
I mean, if I was 5 years old, that would make sense to me.
Right. I mean, this is all basic economics, whether we're talking about Bitcoin as a bank and being a trusted, secure accounting ledger, or whether we're talking about DeFi and crypto credit markets that are under leveraged and over collateralized. That's why billions of dollars is leaving the traditional system and coming into cryptocurrency. I'm sure some of it is because the people are just starting to figure out that Bitcoin is not going anywhere. This asset class is not going anywhere, and it is a store of value. But like I said before, it's so much more than that, because not only can you store your value, but with the advent of DeFi, you can now manage and broker your value and generate yield with it. And you can generate yield in the 8 to 12% range, when in the traditional markets, if you put your money in a savings account, you're getting less than 1%. Or if you're well off and you probably have a meeting with the bank VP every once in a while, maybe you're getting 2.5%, 3%. But that's still not going to be enough to outpace inflation because the dollar is being devalued at a much faster rate.
Okay, so you just mentioned something pretty important. If you want to broker your own money or your own crypto to create yield, you can. Explain how that's done.
Yeah, so instead of letting the bank be the brokerage or be the dealer, be the loan writer, DeFi allows you, the owner of the asset, to be the broker. And this is done in a couple different ways. The most popular way that it's done right now is through the automated market making protocols. An example of this would be like Aave. So what you would do is in your Ethereum wallet, you would have a stable coin, say like USDC, and then you would take your USDC from your wallet. So there's no middleman because you control your wallet. And then you send your USDC and you provide it as liquidity in the Aave protocol. When you do that, those funds become locked up. So you can't just transfer them and take them and do whatever you want with them. When you're providing it as liquidity, it becomes locked. But when you are...
So just to clarify, Aave is what? Is an Ethereum token?
Aave is an ERC20 token. It's a DeFi protocol built on the Ethereum network. And it is what they call an automated market maker. So it's basically a bank that is run by an algorithm. It's automated. There's no human decisions or emotion that needs to be involved. Now,
I take USDC, which is basically US stablecoin. It's a 1-to-1 ratio between the US dollar and the USDC. I take that USDC and then what? I put it into Aave, and then I'm loaning that out to people.
you provide it as liquidity, and then people can come and borrow from it. So how it works is, let's say you have $100,000 and you provide it to a liquidity pool that has $1 million. So you are 1/10 of that liquidity pool.
Okay.
Well, as people borrow from that pool and then pay back their loans with interest, you receive 1/10 of that interest since you provided 1/10 of the funds.
Okay. That makes sense.
See, in the traditional system, the banker will broker that loan, take their cut, and then give you what's left over. And in today's system, there's nothing left over after they take their cut. But in the crypto credit system, you eliminate the banker, you become the broker, and you receive the full cut.
Yeah, no, that makes tons of sense. And okay, so you mentioned ERC20 tokens, AAVE being one of those tokens. What else, like what other ERC20 tokens should people know about? Like what else can they do on the Ethereum blockchain that can help them generate yield? Like I feel like they're so useful, but nobody knows anything about these guys.
Right. So I think the core foundational understanding needs to be that Bitcoin is not just digital gold, and what's being built is a replacement financial system. So it's going to afford 3 benefits that the traditional system also offers, but with no benefits. And number 1 is you got to be able to store your value. So we talked about that last week with Bitcoin being a store of value. Number 2, you have to be able to manage your value. We're talking about that today with DeFi, how you be your own broker.
Managing meaning like generating yield, getting interest on your own money, loaning it out, being your own broker, like you were alluding to.
That's right. Managing and growing your own wealth.
Storing your value would be, okay, I have this money and I want to protect it from inflation. I don't want it to go down in value because the government keeps printing money. You buy Bitcoin. You let Bitcoin sit and it grows in value with Bitcoin. And it also is a hedge against the inflation. If you want to manage your value, like you were saying, then what you would buy, like Ethereum. Is there any other ones that are like fall into that category?
Yeah. So when you talk about the manage vertical, so that you have to store your value, you have to manage your value, and lastly, you have to spend your value. And there are different solutions for each one of those verticals. So focusing on DeFi and the management aspect of this financial system, it really breaks down into 3 different things. Number 1, you have automated market makers, like we just talked about, like Aave. Number 2, you have oracles, which we haven't mentioned yet, but when you're using an automated market maker, it's a contract. So that smart contract has to be settled with accurate prices in order for the contract to be valid. Well, these oracles like Link or Band or Decentralized Information Asset or API3, these are all different oracles that are ERC20 tokens that are designed to go get these prices, go get these reliable prices, to relay that price information, typically through an API, so that the contracts can be settled. So that's one of the critical elements. So you have automated market makers, oracles, and lastly, you have decentralized exchanges, which is critical for liquidity provision and facilitating the markets. So decentralized exchange would be like Uniswap or SushiSwap, right? Okay. So you need these 3 elements in order to offer the digital financial services that are going to mimic the traditional financial services, but with all the added benefits that should be coming with those services. So within Ethereum ecosystem, and there are other DeFi ecosystems that are on deck. Cardano and Polkadot are both 2 different DeFi ecosystems that will be going live later this year. That's something to keep your eyes on for sure. But right now, the Ethereum ecosystem is live and working, and it has yields that are higher than the traditional market. That's why these other DeFi ecosystems are popping up. They've seen the success of the Ethereum ecosystem because real yield is here. And what this is showing is not only what we were talking about earlier with Wallstreet bets, just showing that the game is rigged and it's a gimmick. What this is exposing is that the credit markets are a game. The credit markets are rigged. The bond markets are rigged. And guess what? They're not rigged for the small guy. They're rigged for the hedge funds. They're rigged for the elites, not for us. So they can borrow their money for cheap. They can borrow their money for basically nothing and then pay us, the savers who are trying to get forward and move ahead, pay us nothing, because guess what? They're not paying nothing. So if these rates could go back to the free market level where they should be, you would see exactly what you would see in DeFi, not what you see in the traditional system.
Okay. So I think that was a really good explanation of like the three key components of a DeFi ecosystem. I know you mentioned in there that smart contracts were involved. Let's go through what a smart contract is.
Right. So a smart contract is exactly what it sounds like. It's any type of contract that you could write in the real world, but it's going to be settled automatically. And that's where the smart comes from. As soon as the conditions in the contract are met, then the contract will be executed.
What would be an example of like conditions within a smart contract?
Okay, so let's say that you want to borrow $100,000.
Yeah.
So the contract will have a loan to value ratio preset within it. Typically, that loan ratio is like 0.6 or 0.7. So if you brought $100,000 worth of Bitcoin to the table, you're only going to be able to borrow $60,000 or $70,000 against it, right? That's one of the reasons the crypto market is so healthy, by the way. In the traditional market,
over that, yeah.
That ratio is up to 10x plus.
Yeah.
So, people are borrowing at rates that are 10 times their leverage or even more. If you're a corporation, you can get away with 20 times, 17 to 20 times your leverage.
And you just make it a liability balance sheet. It's so rigged.
Right. So in the crypto credit markets, we don't let that happen. If you want to borrow, if you got $100,000 worth of Bitcoin, you're only going to borrow $60,000 to $70,000. So if you're borrowing that at 10%, let's say you borrow $70,000 at 10% in 1 year, that means in 1 year you have to pay back $77,000. What happens if you default? Well, the broker becomes extremely happy because you took $70,000 and now they get to keep $100,000.
Yeah,
right? So they want you to default. Does the traditional system want you to default? No. That's their biggest fear. That's why they're pushing back forbearance and foreclosure. That's why they're pushing all these things back that people can't pay right now, because if it fails, then everything's done. The whole illusion disappears overnight. So they got to just push it back. When rather in DeFi, we're happy to let you default because you're actually putting down more collateral than is needed to borrow from. So you're over collateralized so that you put that in that smart contract, right? And let's say the price of Bitcoin, you put 100,000 in at 30,000, but then the price of Bitcoin goes all the way down to 15,000. Well, the collateral you deposited with Bitcoin at 15,000 is now only worth 50,000, right? But you borrowed 77,000. So as Bitcoin is dropping in value, by the time that value of that collateral gets to 77,000 to cover what you owe the contract will close, take your Bitcoin and sell it so that it's a break even and nothing is lost. So that's what a smart contract is. This thing is you deposited 100,000, you can pay back 77. But if your collateral goes below 77, we close this contract and take your Bitcoin. Deal? And when you deposit to the smart contract, you're saying, yes, that's a deal. So if the price were to collapse like that and your collateral couldn't cover your loan, then the smart contract executes and the loan is executed at 100%. So that's the example of how a smart contract would work for an automated market maker.
So quick question about that, because that's a lot to take in at once. I'm putting down $100,000 and I'm getting $70,000 as a loan. When I pay back the $77,000 at the end of the year, I get back the rest of my collateral, right?
All of it, yeah.
So what if Bitcoin goes up 100%? Do I get all of that back, or do I only get $100,000 worth back?
You get all of it back.
Okay.
So you're thinking in dollars and not in Bitcoin.
Not in Bitcoin, yeah.
You're never going to lose your Bitcoin, and if the Bitcoin goes up in value, fantastic. You made a smart decision. You can actually take out more money because your loan to value ratio would decrease, right? So if Bitcoin went from 30 to 60,000, or what we said it was at 100,000, we were borrowing 70. So if it goes to 100,000 to 200,000, you can borrow another 70,000 and still be within the range that you want to be with your loan to value ratio.
So, okay, no, that makes sense. That was answering my question I was about to ask. Okay. It's just a lot to take in. It's very confusing when you first learn it. And I think a lot of our listeners can relate to that because this is a totally new ecosystem, a totally new environment. And I think a lot of people don't even believe that it's real.
Right.
But it is.
Well, here's the thing. Be your own banker means you have to do the job of a banker.
Yeah.
Be your own broker means you have to do the job of a broker. So where we are right now in DeFi is that if you are not a professional banker or don't understand how it works, or if you are not a professional broker or don't understand how it works, you're not going to be able to use this system, right? This is not Robin Hooded yet. There's no easy, basic user interface for you. You got to go down to the technicals and you got to know what you're doing because that's where we are in this market. But as the market matures, there will be applications and companies that pop up that make these things easier. And some people will choose to go that path where they have that middleman in the DeFi world because the middleman's taking his cut and they're still getting more than from the traditional system where they get no cut. Or some people will go like I do and want to be their own bank, be their own broker and take on that full responsibility, but also reap the full reward.
So where is DeFi today and where do you see it in 10 years, like as a mature market?
So DeFi really started basically in 2018. So DeFi is in year 3. So you have all these people who are holding on to real estate, all these people who are holding on to bonds because they've been conditioned into that scenario. They are making the smart decision based off of the evidence that they have through their entire life. This is year 3 of being able to use Bitcoin as a digital store of value and use that value in DeFi to generate yield. Now, in 2018, this was few and far between. You had to be a nerd. You had to be a geek who was interested in these things. Like I laugh about it because I was using Aave when it was Lend, and I had no idea what it was going to be. I wish I would have bought so much more. I wish I would have provided a lot more liquidity. Nobody knew at that point. It's like a test. It's kind of like Bitcoin at the beginning, right? It goes live. You can turn on your computer and mine hundreds of Bitcoins a day. So push comes to shove, 10 years ago, you could have made millions of dollars a day by just turning your computer on and mining Bitcoin. And today in the DeFi markets, you can make millions of dollars and high yield compared to the traditional system by just being involved because we're only in year 3. So, where was Bitcoin at year 3? 2012, it's barely trading for dollars. It's fluctuating, it's volatile. Nobody believes in it. You see Twitter accounts that have tweets from 2012 where it's like, sold all my Bitcoin today, probably going to crash from here. And the price that day was like $12, and you're like, oh my gosh, this guy sold like 10,000 Bitcoin. If he just held them, he'd be a deca millionaire. So that's the kind of growth I think is poised for the DeFi market. And people are like, well, how's that possible? Because the money market is the largest market in the world. We're talking about a multi-trillion dollar money market. We're not talking about selling computers or selling cell phones or selling software and just selling it in one demographic or to one geographic region. We're talking about the entire world and all of money. It's the biggest market in the world, and it will continue to mature and grow over the next 10 years. That's 2 more Bitcoin halvings. There's a Bitcoin halving in 2024, and then there's a Bitcoin halving in 2028. Stock to flow valuation on Bitcoin in 2024 goes to $1 million. After that, it goes even higher. Maybe the dollar won't even be the reserve currency by 2028 at the pace that we're going right now. We've gone full Zimbabwe. We've surpassed Venezuela, and we've gone full Zimbabwe by printing 23% of our dollar supply in 1 year.
Yeah, I mean, we're definitely looking a lot like Venezuela right now with rigged elections, bailing out the big hedge funds and everything. But to get back on task, so it sounds like let's go over again the 3 main DeFi protocols. You have the Oracle. It starts with Aave. What is Aave's role called again? An automated market maker.
That's right, automated market maker.
An automated market maker, and that's allowing you to broker out crypto.
It's allowing you to use smart contracts to facilitate the crypto credit markets, to facilitate the borrowing and lending markets.
Okay, and then the second one is an Oracle like Chainlink, And what does an oracle do?
An oracle retrieves the real world price values and relays those values to the smart contracts so that the contracts can settle accurately.
Okay, that makes total sense. And then third would be like a decentralized exchange, I think it was called, like
That's right.
Uniswap. And what is that exactly?
That allows you to raise funds and provide liquidity for the ecosystem without any middleman.
Okay, so that's like the liquidity pools.
The automated market makers are liquidity pools.
Okay.
And then there are also liquidity pools on the decentralized exchanges, which they call DEXs. So on these DEXs, you can provide liquidity. And the thing is that you're always chasing yield, right? And remember, the rates are based on the supply of money and the demand on loans. So if the supply of the Aave liquidity pool is too high, then the yield is going to be low. So what do? You pull that liquidity and you bring it over to Uniswap and you provide liquidity there where the supply is lower and you can get a higher yield. And these things are constantly balancing back and forth as money goes from lower yield to higher yield. Then from that yield will eventually suppress and then people move to another place. And you have to move your money all around. It really is. If you want to get optimal returns, if you want to get into that 12 to 15% range, it's a job. You're a broker. And you have to handle it that way. But like I said, there will be services and companies in the future that pop up to help people with this because we understand not everybody has the time and energy to do their day job and also be a banker or also be a broker. So there will be companies popping up definitely in the next 4 years that are going to reshape the way finance works as we move into the technocracy or the technology-driven humanity.
Okay, so those three protocols, the automated market maker, the oracle, and decentralized exchange, those are all, the ones we all list are all Ethereum tokens on the Ethereum ecosystem. As other DeFi projects come about, like you mentioned earlier, like Cardano and Polkadot, are those same type of protocols going to come about within their ecosystems? Like they're going to have an automated market maker, an oracle, and a decentralized exchange on both of those different projects as well?
Yes, absolutely. Those verticals are foundational to offering the digital financial services.
Okay, so though that's obviously a good investment opportunity then. And this is not investment advice, this is our opinion. In my opinion, that sounds like a good place to look. Because if you look at how it's evolved within the Ethereum, it would have to evolve that way within the other ones as well, correct?
Yeah. So back in 2018, there was less than $1 billion locked up in DeFi. And here today, last time I checked, it was over $17 billion that was locked up in DeFi. So there's $17 billion right now going around the Ethereum ecosystem looking for yield. And that's $17 billion is no joke. It's a little puddle compared to the hundreds of trillions of dollars that float around in the bond market. But when it comes to Wall Street bets, when it comes to retail, you have $17 billion floating around this market and it's not going anywhere. And this market is growing faster than any other market. A lot of people are saying alt season, alt season, alt season. Well, guess what? We just had our alt season, right? As Bitcoin corrected from 42 down to where it is now, we had alt season. And guess what? Your alt that you bought in 2017 isn't doing that well, is it? But guess what is doing well? Guess what is at the top of the leaderboard for all percentage returns? DeFi. It was not an alt season. It was DeFi season.
Except for Dogecoin.
Except for Dogecoin. But again, that's Robinhood. Here's Robinhood screwing their customers. Well, I can't call them customers, right? Screwing their product by offering them cryptocurrency like Dogecoin, which is worthless. Crypto OGs buy Dogecoin when it's low. So when suckers rally into it, we take their money and then put it into real projects. So that's why Bitcoin.
Yeah.
That's why Bitcoin and DeFi is up today, not because Elon Musk tweeted it, because a whole bunch of people who had to make a bad decision because Robinhood is offering them a shit coin gave money to crypto OGs to go spend on real projects like Bitcoin and DeFi. And they are the meme because they're holding on for $1. They will always be the joke, holding for $1 as they give us their money over and over and over again to go put into real projects. I mean,
they're like, oh, that was a quick 8x in 4 hours. Let's just generate yield on that now.
Yeah, I mean, it's a casino. There's no foundational value. We talked about Bitcoin last week having a cost of production. It's a meme coin. Turn on your computer, mine some of it. Like, why pay for it? It's just people who don't know what they're doing being led by people who don't care, who have malicious intent for those people because they're not their customers, they're the product. So what they can do is they can say, wow, look at how many people are interested in cryptocurrency. Out of our millions of customers, 80% were interested in Dogecoin. So 80% have no idea what cryptocurrency is, but are willing to throw their money into it. And then they sell that statistic as well as other statistics that they can break down from their data to hedge funds and research firms. And the customers are really the product, not the customers. The real customers are the people who are buying that data. And Robinhood is screwing people over by even offering that.
Okay, so kind of going back to DeFi, the way you explained and how you can generate yield through those 3 protocols, I mean, I think for the average person, it's going to be kind of confusing. And the way I have personally been doing, like generating yield, is through staking. And it just seems like a lot easier than having to go through the decentralized exchange.
Well, let me stop you right there because staking is actually not generating yield. Staking is a process from a blockchain that uses proof of stake as a way to mine. So when you are staking your coins on a POS chain or a proof of stake blockchain, you are actually the miner because there are no miners. It's the stake coins that perform the functions of a miner. And you are then therefore receiving the rewards that a miner would receive typically. So you're not actually staking and generating yield. You're staking and getting rewarded in more coins, which is a form of dilution. Those coins have to be created in order to be given to those who are staking. So it's a different cryptonomic system than a proof of work blockchain. In a POS blockchain, the stakers become the miners, and then the miners who are the stakers receive the reward. The reward is dilution. It's not a yield made from a profit, right? That was not earned. It was just created and given. So it's dilutionary rather than a profit mechanism. Whereas if you put your money into a liquidity pool, then somebody is borrowing from that money and paying back with interest. So that money is earned, not created. And then that interest is paid. So that would be interest earned. Just didn't mean to interrupt you. Just wanted to be clear about that.
No, I'm glad you did, because that was something that I was obviously wrong about. So when I'm staking, I'm actually just mining more Polkadot or mining more Ethereum. I'm not necessarily, generating interest on my investment. Technically it is interest. You're getting paid in more coin, but like you said, it's diluting the actual like overall amount that's in the system or the value.
Yeah, that's absolutely right. You're spot on. That's absolutely right. And the best way and easiest way right now for people to generate yield with DeFi is to not necessarily be your own broker, but to find a broker in the digital world that you can trust. And I recommend Nexo. Okay. I've been with Nexo from the beginning. So full disclosure, I'm a Nexo token holder and I'm intimately involved with the platform, but I highly recommend it because all you have to do is deposit your USDC stable coins to Nexo and you will earn 8% interest per year. So remember, it's USD savings. There's 0% drawdown. You put in $100,000 next year, there can't be less than $100,000. It's a savings account. There's going to be $100,000 plus your 8% interest. And there's other incentives they have for Nexo token holders, such as owning 10% of your deposit value in Nexo. You'll be able to earn 10% interest per year instead of 8. So to really get involved with the system right now and support the company, you're able to generate 10% per year on your savings with 0% risk. That offer is not anywhere on the table, anywhere else in the entire world.
So is basically what's happening is instead of like me going into Uniswap and like doing all of this yield farming, so to speak, myself, like Nexo's just doing it in the background for me and then just paying me the interest.
Exactly. So Nexo is writing that loan for 10 or 12% and then giving you a cut of 8 to 10% and then taking what's left over for themselves.
Okay. I mean,
just like you would see in the traditional system, except the rates are healthy and they can actually give you that cut. Whereas in the traditional system, the rates are dead. They're dead. They're going negative and you're not going to get anything. And when they go negative, they'll start to take money from your principal in your savings account. So your savings account will start to go down. And it's supposed to be a tool that makes it go up. That's not here yet. That's over in Europe, though. They have that in Europe, and it's coming here soon.
So I think this is really important to highlight for our audience. So I have $100,000 in USD right now. All I have to do in order to generate this 8% on it, I have to convert it into USDC, which is a 1-to-1 ratio. Like I don't lose any money doing that. And if I just deposit the money to Nexo and then convert it to USDC, instantly I start getting paid 8% interest.
That's right.
How often do I get paid?
Every single day. 8% annually, not per day. So
yeah.
Over the course of the entire year, it will add up to 8%.
Yeah, it's just, you get the daily rate of that 8% on 100K every day.
Correct. Okay. And it compounds. So technically it's like 7.9%.
And I can take it out. Like, let's say I want to take out my 100K after 6 months. So now it's, 100K plus, whatever, I guess it would be 4%. So it would be like 104K.
That's right.
I can just take that out and I don't get any penalty. I don't have to like leave it in there for a whole year.
No, it's just like a regular savings account. You come and go as you please and you earn on the amount that's in there.
So it's basically like generating cash flow.
It is what I call the cash flow king. Yeah. Because if you are invested in Nexo and you are ready to go to the next level, if you can put $600,000 on Nexo, you will earn at 10%, you will earn 60 grand or $5,000 per month. Now I have a family of 4 going on 5, and that's enough to cover me. So I don't even need to work a job. I wouldn't have to do anything if I didn't want to, because I have a piggy bank that is spitting out interest for me to pay and cover my expenses. Whereas the traditional system doesn't teach you that. The traditional system says, build up your piggy bank as big as you can get it, because one day you're going to need to start picking from your piggy bank. So you better save. Yet at the same time, they give you no interest on your savings and they double screw you. The real way to generate wealth and store wealth for your family generationally is to create cash flows so that you don't have to pick out of your piggy bank. Your piggy bank is spitting out dollars for you. And eventually you can get to a place where it's spitting out so much money that it just starts compounding because you're making more in interest than you have in expenses.
Yeah, no, I mean, you're basically getting a salary just for holding your money in Nexo instead of a bank.
Right. So the best way to do this traditionally used to be through bonds and real estate. But since DeFi is now come to fruition in 2018, we're on year 3 of it being a better way to store value, manage value, and generate passive income, generate cash flows. And people are conditioned. That's not safe. That's too high risk. Blah, 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 blah. Wait a second. Too high risk. The traditional credit system is leveraged at over 100 times. The crypto credit system is leveraged less than 1, right? It's over collateralized. It's under leveraged. What's more risky? There's a higher chance of your dollars in the bank not being there than your dollars in the cryptoverse not being there, because even the people who are borrowing from your dollars in the cryptoverse are putting more money down as collateral than they're even borrowing. So please walk away. We'll make more money. It's just common sense. It's very simple. It's just math. It's just economics. And this is the new paradigm. We are shifting into a new paradigm, not because we're being forced to, because it just makes sense to get 8% on your savings instead of 0.1. It just makes sense to not trust an emotional human being and to trust an algorithm that is not going to be biased or apply its code to you differently than to somebody else.
So explain to me why someone, and this is kind of going back to one of our earlier points. Explain to me why, like, okay, so like, why would I put a Bitcoin down as collateral to get a loan? Like, what would I do with that loan if I did that? Like, why would someone do that?
Right. So the whole point is because you want to see debt is not always a bad thing. In an unhealthy traditional system, it's mostly a bad thing. But in a healthy credit system, it can be a good thing. Here's your example. Let's say you have one Bitcoin and it's worth $200,000. And you say, you know what? I'm going to sell my Bitcoin and I'm going to buy a condo and I'm going to rent that condo out. And then after I pay all the cost and management fees and stuff, this thing should probably make me like $15,000 a year. So not only is it paying for itself, but it's making me some extra money on the side. This is fantastic.
But you lose your Bitcoin.
Right, but you lose your Bitcoin. Exactly. There you go. That's the kicker. Here's the difference. Now you take that same Bitcoin worth 200,000 and you say, you know what? I'm going to borrow against my Bitcoin. Now I'm going to borrow against my Bitcoin at 10%. So I have to pay back 220,000. But that's okay, because after I pay back that 220,000, remember, the house is going to generate you that 16, 17,000. So for an additional 3K, you can now have a property and still hold your Bitcoin. So you're leveraging your asset to grow and expand your wealth. Whereas before, you're just selling off your Bitcoin and getting something else. So the advent of DeFi is allowing those who have Bitcoin and want to use it to grow their wealth, to be able to extend and diversify, they're able to do that. And they can do it between 8 and 12%. And that 8 and 12% is worth it, because not only do we get the new house that's generating the cash flows, but we also get to keep our Bitcoin. So we're happy to pay 8 to 12% because we get the best of both worlds. It's a healthy market. By the way, after we buy the house and we get our Bitcoin back, we put it into our account and start to generate even more yield with it. So it's one and done versus sustained growth. Okay,
no, that makes sense. It makes sense. So like, if I were to take out, okay, the same exact situation, I took I could put my Bitcoin down as collateral. I got, let's just say it was 160K in a loan, which would be, a portion of my Bitcoin. And I bought a condo with the 160K. Now I don't have the 160K to pay back. Where am I going to get that money to pay that Bitcoin back within a year? From renting out the condo, is what you're saying?
Yeah, and it doesn't have to be in 1 year. You can keep paying back with interest over and over and over and over again.
Okay, so what you would want to happen, extend the loan longer than a year then.
Yeah, absolutely. And what you would want to happen,
I could do like a 30-year loan then if I wanted to.
Sure, if you wanted to, it'd be at 8% per year, so you're incentivized to pay it off quicker rather than holding it.
Yeah, but if I didn't have the capital to pay back in a year, I could just extend it.
Yeah, you could. So if that house was generating for you and can cover the 8% per year, so maybe you owe $14,000 a year on the loan, but the house is generating $17,000. So you net 3 and take the 14 and pay, and you keep doing that until it's all the way paid off. Or what you preferably would do, what typically happens is Bitcoin then increases in value, and then you can take your Bitcoin back because you don't need to. If you put one full Bitcoin at 200 to borrow your 160 and Bitcoin goes from 2 to 400, then you can take half a Bitcoin back and only leave half a Bitcoin in the contract because it meets your loan to value ratio. You stay at that same.
And then just borrow on that half a Bitcoin.
Yeah, exactly. Yeah. You just keep doing it over and over and over and over and over again, especially during bull phase B when the market is going up and we're in a bull trend. During the bear phase or the accumulation phase, this is not the right strategy to use. But during bull phases, this is the right strategy to use.
Well, before we wrap up, is there anything else that you want the audience to, keep in the back of their mind and to know about DeFi?
Yeah, absolutely. I think the number one thing I want to say, and it's not really even DeFi specific, I just want to plead with you to take a look at what's going on. You cannot trust the government. You cannot trust the bankers. You cannot trust the politicians. You cannot trust these people. So stop trusting them. They've screwed us over and over and over and over again. They've bailed themselves out over and over and over again. They've made the law apply to them differently than they would apply it to us over and over and over again. Are you fed up yet? Are you done yet? It's time to be your own bank. It's time to be your own broker. And if you don't want to do it, then you're going to go down with the traditional system because it is on the brink.
Thanks, CJ. Yeah, that was a really great way to sum up the episode. And thanks again for coming on, and looking forward to having you on again so we can drop some knowledge.
Yeah, absolutely. Got to have it. Little sneak peek for you.